Hello everyone. Today our new presentation topic is understanding how inflation happens in any country, presented by options and ideas. Let's start our presentation. Introduction to inflation. Inflation is the rate at which the general level of prices for goods and services rises, reducing the purchasing power of money. This means that over time, each unit of currency buys fewer goods and services. Inflation affects economic decision-making at all levels: households, businesses, and governments. It influences interest rates, wage negotiations, savings, investments, and even social and political stability. Understanding inflation helps in planning for the future and protecting economic stability. Key factors contributing to inflation. Inflation is influenced by a myriad of factors, including demand, pull inflation driven by consumer demand, cost, push inflation from rising production costs, and built-in inflation due to wage-price spirals. Additionally, external factors such as international trade, exchange rates, and global economic trends play a crucial role in shaping inflation dynamics globally. Types of inflation. Demand, pull inflation. This type of inflation occurs when aggregate demand in an economy outpaces aggregate supply. It is often associated with an expanding economy, where increased consumer confidence and spending drive up prices. This can be triggered by low unemployment, rising income levels, or expansive fiscal policies. Cost push inflation. Cost push inflation happens when the cost of production increases, leading to a decrease in the supply of goods and services. Common causes include rising labor costs, increased prices of raw materials, and higher energy prices. Companies pass these costs on to consumers in the form of higher prices. Built-in inflation. Also known as wage-price inflation, built-in inflation is driven by the expectation that current inflation will continue. Workers demand higher wages to keep up with inflation, and businesses increase prices to cover the rising labor costs, creating a cycle that perpetuates inflation. Comparative analysis of inflation causes globally. While the mechanisms of inflation are influenced by various factors, a comparative analysis reveals unique causes globally. Economic structures, policy implementation, and external factors impact inflation rates differently across nations. Understanding these variations is essential for policymakers to devise effective strategies to stabilize inflation and ensure economic stability. Causes of demand, pull inflation. Economic growth. In a booming economy, increased consumer confidence leads to higher spending on goods and services. This increased demand can outstrip supply, causing prices to rise. High consumer and business confidence often lead to more borrowing and investment, further fueling demand. Monetary policy. Central banks may lower interest rates to stimulate borrowing and spending, which increases the money supply. If the money supply grows faster than the economy's ability to produce goods and services, prices will rise. Expansionary monetary policy is a common cause of demand, pull inflation. Government spending. Large-scale government spending, particularly in times of economic downturn, can increase aggregate demand. For example, during a recession, governments may inject money into the economy through stimulus packages or infrastructure projects, which can lead to inflation if not carefully managed. Causes of cost push inflation. Rising wages. When workers demand and receive higher wages, the cost of production increases. Businesses often pass these costs on to consumers in the form of higher prices. This can happen due to strong labor unions, a tight labor market, or government-mandated wage increases. Supply chain disruptions. Increases in the cost of raw materials, such as oil, metals, or food commodities, can lead to higher production costs for businesses. If these costs are significant, they will result in higher prices for consumers. For example, a spike in oil prices can increase transportation and production costs across the economy. Raw material costs. Events like natural disasters, geopolitical conflicts, or pandemics can disrupt supply chains, reducing the availability of goods and leading to higher prices. For instance, a hurricane that destroys crops can reduce food supply, leading to higher prices. Built-in inflation and expectations. Wage price spiral. This occurs when rising wages lead to higher production costs, which businesses pass on to consumers in the form of higher prices. As prices rise, workers demand higher wages to maintain their purchasing power, leading to a continuous cycle of wage and price increases. Inflation expectations. If businesses and consumers expect inflation to continue or accelerate, they may take actions that contribute to inflation. For example, businesses might raise prices preemptively, and workers might demand higher wages, both of which can drive further inflation. Managing inflation expectations is a key challenge for policymakers. Impact of inflation on purchasing power. Inflation erodes the purchasing power of money. For example, if inflation is 5% per year, something that costs $100 today will cost $105 next year, reducing the amount of goods and services that can be bought with a fixed income. On savings and investment, inflation can diminish the real value of savings. If the interest rate on savings is lower than the inflation rate, the purchasing power of saved money decreases. Inflation also affects investment returns, as investors demand higher returns to compensate for the loss of purchasing power. Economic uncertainty. High or unpredictable inflation can create uncertainty in the economy, discouraging long-term investments. Businesses may be less likely to invest in new projects if they are uncertain about future costs and returns, leading to slower economic growth. Measuring inflation. Consumer Price Index, CPI. The CPI measures the average change over time in the prices paid by consumers for a basket of goods and services. It includes various categories like food, housing, transportation, and healthcare. CPI is a key indicator used by policymakers to gauge inflation. Producer Price Index, PPI. The PPI measures the average change in selling prices received by domestic producers for their output. It includes goods at the wholesale level and is a leading indicator of future consumer inflation, as increases in producer prices often lead to higher consumer prices. Controlling inflation. Monetary policy. Central banks, like the Federal Reserve or the Reserve Bank of India, control inflation by adjusting interest rates. Raising interest rates makes borrowing more expensive, reducing spending and demand, which can help lower inflation. Central banks can also use open market operations to control the money supply. Fiscal policy. Governments can control inflation through fiscal policy by reducing public spending or increasing taxes. Reducing public spending lowers aggregate demand, helping to cool down an overheating economy. Increasing taxes reduces disposable income, which can also reduce demand. Supply-side policies. These policies aim to increase the economy's productive capacity, thereby increasing supply and reducing inflationary pressures. Examples include investing in infrastructure, education, and technology, or reducing regulations that hinder business efficiency. By making the economy more efficient, these policies can help keep inflation low. Conclusion. Inflation is a complex economic issue that arises from various factors such as excessive demand, rising production costs, and expectations of future price increases. It affects purchasing power, savings, investments, and overall economic stability. Understanding the root causes of inflation is essential for devising effective strategies to manage it. While moderate inflation signals a healthy economy, excessive inflation can lead to significant economic challenges, including uncertainty and slower growth. It is crucial for policymakers to strike a balance in their approach to managing inflation through monetary, fiscal, and supply-side measures.
Thanks for the watching video.